to gold. Jim, last time we spoke, you had a potential outlook for gold at $10,000 by the end of the year. You said that that was feasible, and you broke down to us how that is feasible. In light of this conflict, where do you see gold ending this year?
The Strait of Hormuz was closed almost the day the war began. I think it was February 22nd. I mean, check me on the exact day, but it was around the end of February. The idea that the stock market is an efficient information machine, a discounter of future news is nonsense. That's like Egghead, Eugene Fama. They all won Nobel Prizes for things that are Fed creates money, and they do create money. You're right about that. So how does the Fed create money? How do they print money? Well, what they do is they have an open market trading desk in New York, and they call up the primary dealers. That's Goldman Sachs, Morgan Stanley, and Citi, and JP Morgan, and all the big banks.
Friends, Jim Rickards just dropped a bombshell. He's saying a global recession isn't just coming, it's already baked in because of the Strait of Hormuz closure. If the energy supply chain is broken, the global economy follows. We are looking at a total shift in how the world trades. If you want to stay ahead of this financial crisis, make sure to hit that subscribe button, like this video, and share your thoughts in the comments. Are you prepared for a global downturn? Let's see what Jim says about the stock market's reaction.
A deal which does not seem like it's going to happen, or an escalation?
Yes, and part of the reason it's happening now. Here's what I think a lot of people don't understand in terms of the Strait of Hormuz. The Strait of Hormuz was closed almost the day the war began. I think it was February 22nd. I mean, check me on the exact day, but it was around the end of February. But there was a lot of oil and natural gas and fertilizer, for that matter, in transit that was already outside the Straits of Hormuz. It was unaffected by the closure of the Strait of Hormuz. Now, that can take 2 or 3 weeks to get to South Korea and Japan and India and the ultimate users, and perhaps even longer, as I say in the case of South Korea. So the ships were underway. They were still delivering. The stockpiles were still there. There was nothing about closing the Straits of Hormuz that affected the supply immediately because it was already on the way. But now we're 7 weeks into this. Now the supply has dried up. There are no tankers underway. And it's really just now, as we speak, that the shortage is going to kick in. So are the Straits of Hormuz open? Well, 10 hours ago, yes. Today, right now, no. Who knows about tomorrow? Maybe a few tankers are getting through. But the bigger point is that the pipeline of oil, natural gas, and fertilizer, helium in transit, that has dried up because those vessels have delivered, and now is when the danger really kicks in. Not to mention the infrastructure damage. Even if you had peace, love, and understanding in the Persian Gulf tomorrow, I don't expect that, by the way, but even if you did, the damage to Qatar's liquid natural gas facilities is extensive. That's going to take months, perhaps even longer, to repair. So this economic damage is there, with or without a ceasefire, and the ceasefire itself is incredibly shaky.
Right. So a global recession is already baked in. What does that mean in terms of the U.S. economy? What does that mean in terms of U.S. equities? And what does that mean in terms of a potential response to that? Does that ultimately mean more Fed printing?
Well, we'll get to the Fed, but in terms of the stock market, for example, the idea that the stock market is an efficient information machine and discounter of future news is nonsense. That's like Egghead, Eugene Fama. They all won Nobel Prizes for things that are nonsense. Stock markets are very inefficient. They run on emotion. They don't adjust gradually. They gap up, they gap down. There's volatility, et cetera. So right now, my view of the stock market is that stock markets, and to some extent bond markets, have not discounted what we're talking about. There's the narrative that Wall Street's on, and what the stock market, the market is what it is. I mean, you can't really fight the market in that sense, but there's that based on a narrative, and then there's the reality. Reality always wins, but it can take time. So how many analysts on Wall Street have you heard saying, well, we think the war will be over in 2 to 3 weeks. The war will be over in 2 to 3 weeks. But they've been saying that for 9 weeks. I mean, that's my point. It's like, how many times do you say 2 to 3 weeks, and the 3 weeks go by and you're still fighting when you're like, oh, you know what? Maybe this is going to last for years. Maybe this damage is going to take 6 months to a year to repair. Maybe when you start shutting down refineries, it's not like throwing a switch. You can't turn them on just because the oil shows up. The amount of what you have to do to get that, to prepare that kind of infrastructure to be used again after it's been shut down is enormous. And so that's already baked in the pot. Like I say, even if peace broke out tomorrow, which I don't expect, the damage has already been done. And we haven't, it's just the markets haven't reflected that yet.
Okay, so, and in terms of a Fed reaction to a slowdown, I mean, does that not ultimately lead to more QE in any name, shape, or form, more money printing, more currency debasement, more devaluation, ultimately, I guess, a positive for gold?
Yeah, Fed money printing is so-called is kind of irrelevant. The Fed's mostly irrelevant to everything we're talking about. I'll kind of spend a minute on how the Fed creates money, and they do create money. You're right about that. So how does the Fed create money? How do they print money? Well, what they do is they have an open market trading desk in New York, and they call up the primary dealers. That's Goldman Sachs, and Morgan Stanley, and Citi, and JP Morgan, and all the big banks. And they say, you know, offer me 5-year notes. And the trading desk offers them 5-year notes. Done. The bank sends the 5-year notes to the Fed, and the Fed sends money to, you know, I'll say Goldman Sachs or Morgan Stanley. And that money does come out of thin air. So that's true. But then the question is, what does the bank do with the money? The bank that just sold the Fed the securities, what do they do with the money? They give it back to the Fed in the form of excess reserves. The Fed's a bank, and you can have an account there if you're a member of the Federal Reserve System, and they just give it back to them. That money doesn't go anywhere. It doesn't get lent. It doesn't get spent. It's not stimulating. It actually doesn't cause inflation. It just sits there. It's sterilized on the Fed's balance sheet. Okay. Where does the money come from that does do the things you're raising, that does cause inflation, that does, you know, help the economy or contract the economy? That money comes from the commercial banks. It comes from JP Morgan, the Citi, and, you know, Bank of America and Wells Fargo and all the rest. What are they doing? They can print money too, by the way. People don't understand that. If I go to a bank and take out a loan, and, you know, they prove, okay, I sign a note that says, okay, Jim, here's your loan, and they put the money in my account, where does that money come from? It's ledger money. It comes from thin air. In other words, the banks can create money the same as the Fed. But in that case, I probably borrow the money for a reason, and I'll probably go invest it or spend it or, you know, run a business, do something with it. That's the money that counts. So what are the commercial banks doing in that vein? Well, they're doing the opposite of what you suggest. They're tightening credit. They're concerned. They're going to have write-downs from the private credit crisis. They're going to have customers to go bankrupt because of the higher price of oil. Or the higher price of oil is going to cause people to spend more money at the pump, which means they'll spend less money at the grocery store or you know, entertainment or vacations or clothes or new cars or whatever else it is. That part of the economy, again, where the money actually comes from, that's in retreat. So the Fed is mostly irrelevant. Fed money printing, it does exist, but it doesn't matter because it all stays on the balance sheet. You have to look at the commercial banks, and they're pulling in their horns.
So you're not seeing an expansion of monetary supply of M2 as a result of
this conflict? Yeah, that's correct. Yeah, M2 is a very good measure, and no, not seeing an expansion of M2. We are seeing, we could see more of an expansion of M0, which is the Fed money. But as I say, it's irrelevant because it just ends up on their balance sheet. It doesn't go anywhere. Yeah, but you're right. Watch M1 and M2. That's the money that counts.
This is a reality check for everyone who thinks the Fed can just print our way out of this. Jim explains that most of that money stays trapped on bank balance sheets. The real issue, velocity is dropping, and commercial banks are tightening credit. We are seeing a massive dollar shortage globally. While everyone is watching the headlines, the real crisis is happening in the banking system's plumbing. Is the dollar actually in a liquidity trap?
And M2 is typically what leads to inflation.
Well, okay, there's another element in the what's called the quantitative theory of money. Money supply is one of the variables, and real GDP is a part of the equation. Inflation or deflation, as the case may be, is part of the equation. But there's a fourth element that Milton Friedman overlooked. He just ignored it, which is velocity. So it's money supply times velocity equals nominal GDP broken into two parts, real and inflation adjustment. That's the quantitative theory of money, Irving Fisher, around 1920. It's a very good model to think about things, except Friedman and others assume that velocity was constant. Velocity is not constant. So I can double the money supply, but if velocity drops by half, the nominal GDP is flat. In other words, money supply doesn't matter unless the thing you have to watch, the thing that would cause the kind of inflation you're talking about, would be an increase in velocity. But we don't see that.
And bringing it back to this conflict, do you see that? So you're not seeing inflation in terms of what people are paying for the price of goods as a real consequence of this war?
No, we're seeing a lot of inflation, but it's not because of money printing. It's because of supply. It's because of supply shortages.
But I mean, as a future consequence, should
maybe
some kind of stimulus?
Not necessarily. There's nothing there's no stimulus in it. They say there's no cliche. I hate cliches, but some of them are good. The cure for high oil prices is high oil prices. In other words, right now, the price of oil is going up. We're going to see inflation. I'm not arguing that. But I'm saying, where's the inflation coming from? It's not coming from an increase in velocity. It's coming from supply shortages, closing the Persian Gulf, people desperate for oil, natural gas, bidding up the price, et cetera. Gas, I mean, I live, it's kind of not too high. In New Hampshire, where I live, it's already $5 a gallon. I imagine it's $7 a gallon in California. That's going to flow through the transportation costs. Airline tickets are going up. The price of jet fuel is going up. So the inflation is coming. There's no question about that. But you have to ask, why? Where is it coming from? It's not coming from money supply and velocity. It's coming from supply shortages. Now, how does that play out? Well, as I said, if I got to pay $5 a gallon for gas instead of $2.50, I can't not have the gas. I would say in general, American citizens, you got to pick up the kids at school or go to work or go to your job or do whatever you're doing. So the demand for gasoline is inelastic, but demand for everything else, luxury goods, even, clothing, movies, vacations, dinner out, all that stuff, that's the stuff you cut out because you're paying more at the pump. And that can take you to a recession.
So let's bring it back to gold. Jim, last time we spoke, you had a potential outlook for gold at $10,000 by the end of the year. You said that was feasible, and you broke down to us how that is feasible. In light of this conflict, where do you see gold ending this year?
$10,000 is still a realistic estimate. I said some time ago it was $5,000. It got to $5,000. That got smashed down a little bit. It's kind of working its way back to 5,000 in stages. But yeah, it'll go along with the kind of inflation that we talked about, and the things we talked about earlier in the segment, Michelle. Central bank demand is not going away. Supply is flat. Central bank demand is going up. The safe haven asset attractiveness of it is going up. To the extent people do want to, I sort of poured cold water on the de-dollarization thesis, but the idea that central banks are moving from dollars to gold, that's true. It's very well documented. So that will continue to drive it. And then I did the very simple bit of math where I pointed out that if you use $1,000 increment as a marker, each $1,000 increment is easier than the one before because you're working off a higher base. So it's a smaller percentage gain. So going from $4,000 to $5,000 an ounce is a 25% increase. That's a heavy lift. But going from 9,000 to 10,000 is only an 11% increase. That's much easier. So you'll kind of struggle. I don't know if it's the right word. You kind of struggle, or it'll take time to get to 6 or 7, but you're going to go 8, 9, 10 really quickly.
Okay, so that still is on target. And just to be clear here, you do not see this conflict as significantly altering the global monetary system.
The most shocking prediction today, gold at $10,000. Jim's math is simple. As the base price grows, the percentage lift needed to hit the next 1,000 becomes easier. We're seeing a massive shift where central banks are moving away from treasuries and into physical gold, just like Russia did to survive sanctions. If gold becomes the ultimate reserve asset again, the global monetary system will never be the same. Are we witnessing the end of the dollar's era?
I see problems in the global monetary system with or without the conflict. So I'm not sanguine about it. I think there's a lot of trouble in the global monetary system. The private credit meltdown, the central banks going to gold instead of dollars, a global dollar shortage because the banks are pulling in their horns. All of those are problems. The Iran war is kind of an overlay on that. So I think it makes it worse. I would say we have a global monetary problem anyway, but the war makes it worse because of the increase, not just the increase in the price of oil, but the supply. The U.S. is not going to run out of oil. We got plenty. But the rest of the world, South Korea, Japan, China, others, they're going to see supply shortages. They already are.
But in terms of impact of the dollar's status as a global reserve currency, the impact of the war on that?
The dollar will remain the leading currency denomination. Again, it's the denomination that people don't have $100.
Yeah.
Well, the unit of exchange is not the reserve currency. People don't have stacks of dollars in the basement of the central banks. What they have are Treasury securities. And no, I don't see that being rejected, but they are selling Treasuries to get cash, which is a different issue. But gold is going up. I mean, the price of gold is going up, and the percentage of global reserves in gold is going up. It's what saved Russia during the Ukraine war. We froze, 300 billion of their Treasury securities, but Vera Nabiullina, who's the head of the Central Bank of Russia, had put 25% of the reserves in physical gold. We couldn't freeze that. And in fact, when the price of gold started going up from $2,000 to $5,000 an ounce, Russia made as much mark to market on the price of gold as they lost on the frozen treasury. So that was a pretty smart move by her.
And so wouldn't this conflict accelerate other countries saying, I'd rather have gold than dollars?
Yeah, I think that's absolutely right.
All right. Well, we don't know how this conflict plays out. We shall see how this story develops, but always great to get your perspective, your insights, and education on basic economics as well for everyone. So, Jim Rickards, always a pleasure. Thank you so much. For people that want to learn more about you, more about your work, where can they find you?
My flagship newsletter is Strategic Intelligence for Paradigm Press. If you just Google Strategic Intelligence Paradigm Press, you'll find us. And that's it comes out monthly. We do everything we've been talking about in this program. We don't tell you what happened. We tell you what's going to happen next. And on X, at Real Jim Rickards, Rickards, at Real Jim Rickards.
Well, we're both seems unclear on what exactly happens next, but you've broken down the scenarios very clearly and in a tremendously insightful way for us. So thank you again, Jim.